Hi, Adam.
Hello, Margaret.
How are
Hello,
you?
everyone.
How are you?
Good, good. How are we doing?
We're good. Let's give people maybe 10 seconds just to join in, and then I'll just do the intros, then let you take over.
Sounds good.
Yeah. Hi, everyone who's joining us today. Welcome to the Zoom meeting. I was corrected by my children. I'm not allowed to call it a call. It's not a call. This is a Zoom meeting. Just wanted to thank anyone who was on the first webinar and has joined us again. Welcome. Enjoy the journey with us, and you'll see with Adam the input that he can bring to you. For those that have never been with us before, welcome as well. And just remember, we record all these sessions, so if you can't join us on that particular day, we're more than happy to share or pick up the phone and just talk to us. We don't want to bombard you with too much information. So what might happen at the end of this is you might have questions that are really specific to you. Please feel free to pick up the phone and talk to us. If you recall, the last webinar was about how women influence and what our sphere of influence is about. With that sphere of influence, we are going to approach different subjects. And Adam is here today. He's a fellow principal. We work together on quite a few clients, and he's going to talk about how you can utilize that sphere to make sure that you're actually influencing decisions that affect not only your life, but your family's life as well. Adam, I'll hand it over to you.
Thanks, Margaret. Hello, everyone. I hope we're all doing well today. Very excited to be here. Of course, thank you, Margaret, for the opportunity to present and be a part of this. First of all, I guess it's important to state at the outset that no, I'm not a woman. I am surrounded and lucky to be surrounded by some lovely women in my life. My wife, Danielle, who's been working from home out on the kitchen table. Hopefully she's there, so hello if you're listening. I've got two sisters, my mother-in-law, my nonna who controls my nonna's TAB account. Very important women in my life, and I really feel like, if I can contribute to the lives of others, that's, really quite meaningful to me. So I'll jump straight into today's session. Hopefully you can all see the slides nice and clearly. But what I'd like to cover off are three main outcomes for today. I'd like to highlight some of the key issues which have a material financial impact on women, which I've seen throughout my time here at CountPlus One, which has almost been 10 years now, which is quite exciting. Second outcome is to explain how we can help you to set smart financial goals to help address these particular issues. The third thing I'd like to go through is to demonstrate practically how future planning can help you to achieve your overall goals. Try and condense this to 25 minutes, leave a few minutes at the end for questions. Now, it's quite simple to ask questions. In your Zoom window, if you scroll to the bottom, you should be able to see the Q&A box. Simply click on that and enter your question. If we don't get a chance to respond to it during this session, I'll make sure to email you personally with a response as well. Also have to thank Morningstar for their use of this particular Mining for Goals tool. It's a tool that we use with particularly new clients all the time to help them set really clearly defined financial goals. So we'll send you that template after the webinar as well as an additional resource. So before jumping into the goal setting and how I can actually help, I guess it was key to understand some of the gaps that I think, particularly disadvantage women when it comes to them taking control of their financial position overall. So I'll just quickly run you through these high level one by one. So the first of these issues is financial literacy. So there's a few different statistics I wanted to share with you. One of them is this Melbourne University household income survey, which covers about 17,500 people. And essentially what they do is ask respondents about basic financial concepts to gauge whether they understand financial literacy concepts such as inflation or interest or diversification. What the survey resulted in was over half of the male participants could answer the questions correctly. However, only around a third of women could answer the same questions correctly. So there was already a clear knowledge gap as a result of that survey. Following on from that was some research done by Pimco, which is a large fund manager and a manager that we use quite a bit here at CountPlus One. What they basically found out was about 72% of women that they surveyed believe that investing at its core is set up to be confusing. So there's lots of jargon, lots of concepts that aren't really easy to understand. And going on from that, over half of the women surveyed say that the overall financial services industry doesn't actually reflect what is important to them. So there's already clear barriers to entry affecting women's participation in the system overall. Another key concept that I think really needs to be explored further is the issue of wage inequality. So this is an issue that's prevalent throughout the developed world and particularly within corporate Australia. There's a few articles in the Fin Review only on Monday that related back to CBA and Westpac having these issues now with their boards as well. So it's still very much a contemporary issue. So what we find is that not only there's overall wage inequality, but women also have high instances of career breaks. So that is primarily to have and to care for children. So because of the wage inequality, career breaks, what we find is that the ability for women to earn income throughout their life is reduced compared to their male counterparts. And because we're dealing with essentially a smaller sum of money, what we find is that women inherently are more risk averse. They don't like to take investment risk and are more concerned with preserving capital. Where we see that manifest itself quite clearly within our financial system is superannuation. So this was research conducted by the Association of Superannuation Funds of Australia, which found that at retirement, Australian women on average have about $114,000 less in their superannuation balance, which is quite a significant shortfall to have and would definitely impact on your quality of life post your working career. The final issue, I guess, goes without saying, but in this particular economy and really the pace of modern life, time is a commodity which we cannot get more of. What we find again from that Pimco survey I alluded to earlier was that 70% of women are actually looking for ways that they can streamline their overall position and responsibilities. However, 63% of women say that planning for tomorrow is difficult when there's already so much that they're juggling. So we do have this confluence of factors around we don't have the time, there is a knowledge gap prevalent through the statistics, and what that means is there's a clear financial detriment that is suffered by women, particularly in Australia through their superannuation balances. So what can we do to help bridge that gap? And when I was thinking through preparing for the presentation, I really thought through two issues. So there's two parts, sorry. So there's a knowledge part and an implementation or action part. So when you do, or when you think that you need to lose weight, which is something I yo-go with all of the time, the concept is quite simple. You eat less, you exercise more. However, the implementation is the hard part. You know, when it's cold, it's raining, it's very difficult to motivate yourself to get out of bed. So people know what they need to do. However, it's the action part that is lacking. And that's very similar with financial planning and planning in general. People inherently know that they need to save more, spend less, and do something proactive with their money. So the knowledge gap, I guess, isn't so much of an issue in that simple sense, but it's implementation. It's actually having a plan. You know, how are you going to address your goals? How are you going to get there? It doesn't just happen. So that's really the part that we can help you with. And the first part that we really need to work on is setting strong foundations. And by that, I mean, you need to set clearly defined goals for yourself and for your family in terms of what you need to achieve to live comfortably and to cover those financial objectives that you would like. So I guess what we see with clients all the time, they come in and say, your very general goals. So things like amassing wealth, being financially independent, they're great things to strive for. However, there's no specificity around that. What does being financially independent will mean something different to different people. Having a quantity of wealth, I don't know what wealthy means to you or to the next person. So that's where we do need to really clearly articulate and define the goals so that we can have a plan in place and be accountable to that plan. So over the next few slides, I'd like to take you through Morningstar's approach to setting goals. And there's 4 main steps that they say to follow, and it's something that we follow, quite religiously when we do meet with our clients. The first of these steps is to articulate your goals and set clear timelines. So this is where you will think through with your partner, your family, what are the things that we actually would like to achieve? Then perhaps the more important step is to actually define these in terms of time buckets. So is this something we need to achieve within the next 12 months? Is it more of a medium-term goal over the next 3 or so years? Or is it longer term? And what time milestones do we want to set for ourselves so we can actually touch base and reflect and see whether we are on track? The second step, I guess this one goes without saying, but you'd be surprised the amount of people that we see that don't actually quantify their goals. They know that they want to purchase a property. They don't know how much. And so I guess you can have very, wildly different outcomes. If you'd like to buy a property worth $200,000 or $2 million, they're going to be very clearly different in terms of strategies that we would need to put in place to get there. So we really do need to think through and quantify what the cost of these financial goals are. Some basic examples there, but I think you'd get the gist of that. The third one's a little bit harder. It's probably something that really does, I think, require the input of essentially someone that's in the industry and knows how, what sort of strategies we could implement to get there, because this is all about the goal being realistic and taking time to reflect upon whether the goal is something that can be achieved or not. And I think that is almost the light bulb moment that we give to all the new clients that we see, because in some cases we can give them peace of mind that they can comfortably get to their goal by the intended time frame. However, there are other situations where it doesn't really matter what we do. There are finite resources and we just cannot make more of them, particularly time, disposable income, to allow you to get to those goals. So quite often we have to realign expectations to ensure that the goal does become realistic. So do you need to work for a few extra years to be able to retire? Do we need to spend less so we have more of a cash flow surplus to be able to invest to get us to an eventual, say, property ownership goal or a larger one-off expense purchase? So assessing reality is extremely important to the overall process. And the final one is to prioritize your goals. So quite often, again, we see clients come in with conflicting goals. So everyone wants to achieve everything by yesterday. And again, this concept of, having finite resources, finite time, finite money, we can't realistically do everything straight away. So this is where we need to reflect, speak as a family unit and understand what are our most important things that we need to tackle right now. And then what we can do as advisors is look at your priorities and work out financially which ones are going to have the most bang for buck. So which ones are going to get you the best rate of return and make the most meaningful financial impact for you. The little hierarchy that I had there, just some basic things that we would try to think through. So if you have some personal debt with a high interest rate attached, it's not tax effective. In most cases, you would look to try and obviously reduce that to try and give yourself a bit of a buffer. Then it's also very important to always be mindful of retirement at the end of the day. I know for some people on this webinar, that's not going to be in the next 40 years. But again, time is something we don't get more of. And one great financial concept that's very important is compound interest. And I guess the easiest way to maybe understand what compound interest relates to is think of a small snowball rolling down a mountainside. And as it gets going, it gets bigger and bigger and bigger to the point where when you retire, hopefully it's quite comfortable and we don't have to make really drastic actions or, you know, really large last minute contributions to top up a superannuation balance. So I guess what we're saying here is it's a priority from your perspective, and also we could put a lens over the top of it and say, well, if you do this, this is the impact, and try and work out what's the best value goal essentially for you. So just to recap, 4 basic steps: articulate your goals, importantly, allocate them to their own time bucket so that we have an idea of when these things need to be achieved by, quantify the cost of the goal, assess the reality, and prioritize. So all of these things together will allow you to create SMART goals. The Mining for Goals tool will be quite useful, I think, when we send this out to you via email. And I think I'd really like people to work through that and come back to us with some goals that they'd like to achieve so we can have a really meaningful conversation. Now that you've set the goals, I guess what we need to work on is developing a plan. So I guess this is how it all sort of comes together. Once we've set the goals, we need a plan of action and a plan of attack as to how we're going to get there. So what I thought would be good for basically the rest of my presentation is to reference back to Margaret's first seminar, whereby she outlined some key life stages that everyone goes through. So I wanted to break down and provide you with some simple case studies or examples of how we help people in those respective life stages. The first of which is the growth phase. So this would be, I guess, late 20s, early to mid 30s, an age category which Margaret is trying to cling on to. So really within this phase, what we see most commonly is clients are earning more income. You know, it's a nice job that they've landed out of university. All of a sudden there's some disposable income and really they want to know what to do with it. You can't leave it in the bank really because it's earning very little interest. However, you know, there could be conflicting goals around what they would like to do with that money. So what I wanted to show you here, and I guess before I go into that, I should state that everything that we go through in this presentation is general advice. I've not considered anyone's personal circumstances when going through this. So please make sure to reach out to us before you actually do anything. But this basic example, I'll run you through some assumptions I've made here. So we've got an individual that saves $10,000 after tax each year. They're earning $90,000 or more, so their respective tax rate is 39 cents in the dollar. Superannuation is taxed at 15%. They've got a home mortgage, which has an interest rate of 3%, which is great. And the investment return on the particular portfolio is 9%. So that's quite an aggressive rate of return, particularly in the current environment. However, we find usually that younger people have a higher tolerance to risk and have a longer time frame in which to recover from financial downturns. Then in this case study, I've just said, let's invest or, you know, cover that 10-year time period to see what the outcome would be. So what this then relates to from an outcome perspective is that if we took $10,000 and every year put that $10,000 towards reducing the mortgage based on that 3% interest rate, the net benefit is only around $97,000. However, if we be a bit more creative and look outside of the box, you could also think about utilising your superannuation. So the superannuation system is very important for us, particularly when we work with Margaret and the accounting team, because all the while we always try and work through the most efficient taxation outcomes. Superannuation, whilst you can't access it, is taxed at 15%. If you were to contribute those savings into super, what you'll find is that the tax rate, the tax difference is 24 cents in the dollar. So there's a clear benefit there. But also once the money is invested, it's working harder than simply the rate of interest that's applying to your home loan or if it was sitting in a bank account. However, when you are younger, there's a real issue in terms of accessibility. So you can't actually access that money until you meet what's known as a condition of release. So that might preclude some people from actually making these super contributions. And this is where the planning element can really help, because we can compare and really juggle different options. We could allocate some money to superannuation to ensure we get the benefit of the compounding interest. We can allocate some to a savings plan, which would be invested, say outside of super, so that you would retain access to money. All of these things are still going to get you a net benefit greater than simply paying off the mortgage. So it's just trying to encourage you to have an open mind with respect to what you can do with your cash flow. The next phase here I'd like to talk about is the establishment phase, which I guess in my mind was late 30s and into your 40s. And what we find with this particular age group is that the goals, the priorities, the needs shift dramatically, usually due to having children. And all of a sudden it's all about risk minimization and simplification. So what we mean by that is, do you have the right level of insurance cover? Most likely families have borrowed quite a bit of money to potentially move into a dream home or complete major renovations to have room for a growing family. So cash flow is stretched and debt is obviously much higher than it was in the past. And I didn't prepare any sort of fancy model for this particular scenario, because what I find through advising many clients in this age bracket is that a lot of the benefits that I think we give to clients is through intangible benefits. So by having the right level of insurance, what that means is clients can continue to live their life knowing that if something happens to them, be it sickness or injury, they are still able to meet their financial goals and responsibilities without burdening the family and without needing to change their quality of life, perhaps more importantly. The other one is, I guess, by having someone there to help, we can assist in terms of streamlining your overall position. So we're looking at minimizing tax, we're looking at maximizing cash flow outcomes. All of these things really mean that hopefully you have more time to spend with your family to do things that you actually care about. So going on holidays and just really enjoying that particular time in your life. I won't go too much into this because we will do future webinars based solely on insurance and the understanding of the concepts. But as we will share the slides, I just wanted to make a reference to the types of personal insurance that we would usually assist our clients with. The last of these particular life stages is what we call the retirement phase. So this is basically throughout your 50s, going into your 60s. And what we find is usually these are your peak earning years. So you've reached the height of your career, climbed the corporate ladder, earning significant amounts of money. And importantly, the timing almost coincides with kids finishing school, going to university, perhaps having part-time jobs, maybe being less of a financial burden on the family. But I guess importantly, it means that there's extra disposable income that you really need to make some crucial decisions with to effectively build up your retirement nest egg to allow you to live the quality of life that you've always envisioned following your working life. And really the value that I think we provide to clients throughout this phase is the projections and the financial modelling of different scenarios which cover varying strategy recommendations for that surplus cash. Do we pay off remaining debt? Do we put more money into super? Important concepts also, such as government entitlements. How can we provide you with strategy to allow you to maximise any government entitlements you might be eligible for? And really, we can do that by having an in-depth knowledge of taxation legislation, super legislation, and really just the ways that we can, as I said, impact any sort of social security benefits as well. So one way that I wanted to show how this could actually work in practice is by comparing two different scenarios. So the assumptions that underpin this base scenario are as follows. We have Homer and Marge. Homer's 55, Marge is 50. They want to work for another 10 years. Homer earns $150,000 working for Sector 7G at the nuclear power plant. Marge earns $60,000. Homer has $350,000 in super. Marge has $150,000. They spend $80,000 per year prior to retirement. However, once they stop work, they want to spend a little bit more so they can go on holidays and enjoy their time together. Inflation rate, we always have to assume. Interest currently on any cash at bank is also quite low. It's actually really lower than 2% at the moment. And I guess importantly, for the sake of these projections, we've assumed that any surplus income that they have that's not spent is just saved up in cash. So what I'm trying to show is that they don't necessarily have advice and money just sits around in the bank. Whereas superannuation, the rate of return of 6% would reflect more of a balanced type of risk outcome. So what's the result of this? They continue working, adding money to super just through mandatory employer contributions. Their eventual super benefit in future dollars is about 1.6, which is a decent amount. However, once they stop work, you can see how steeply the blue shaded area reduces. That's their superannuation balance. Basically gets to the point where Homer is 90, Marge is 85. That's where their liquid funds would run out. And then we're really at a point where we would need to downsize the home, which is really not a great outcome, particularly with the advancements in medicine. We really want to make sure that that retirement money lasts as long as possible. So what I wanted to show, I guess, in this next scenario was keeping everything the same, except utilizing surplus cash flow in a different way. So both Homer and Marge maximize the amount they can put into super from their pre-tax income, which is currently $25,000 per year. They also use some surplus cash flow to put in after-tax contributions to super as well. What that means is they have more of their capital invested in a concessionally taxed structure. What's the result of this? So by making those higher contribution amounts, our superannuation balance gets closer to 1.8 million, so nearly $200,000 different. A lot more of a gradual decline in the superannuation outcomes. Therefore, the money runs out when Homer's 99 and Marge is 94. So by making those small tweaks, we've been able to extend the longevity of superannuation by another 9 years, which I would consider a really, quite a good outcome. So that's really all I wanted to go through. There's a lot sort of in there, but some next steps that I wanted to share with you before we just jump to some questions quickly. As I said, I'll send through that Mining for Goals resource. I think that will be quite important to work through. Once you've had a go at that and you understand what your, say, top 3 financial goals are, I'd like you to reach out to us via the Women in Focus email and book in a half-an-hour session with us so we can run through your goals and eventually help you to establish a plan to be able to effectively address those goals. The final point as well, please follow us on LinkedIn. Make sure that you stay up to date with all our initiatives and what we're doing at CountPlus One, just so you don't miss anything. I'll stop sharing now and I'll see what questions we have there in the chat.
Excellent, thank you, Adam. That was really good. The joke about my age wasn't funny. I had to burst out laughing. So there's an ongoing joke that the average age of the firm is 29. And I sort of err on caution with that one. I'm not quite there. But Adam, I think you really touched on some really important points, and I'm glad that we're addressing the gaps that women face as we go through life. And I think these conversations and the education and challenging the norm from the past is really, really important. And that's the purpose of all this, is just challenging that norm. From the first webinar, we sat back and looked at the different roles that we play as women. And I think you summed it up really well by focusing on goal setting. And what resonated with me was making sure that those goals are realistic and prioritizing them. So you can't do everything on the onset, but you can come up with a strategy to address what keeps you up at night. And it's all about peace of mind. At the end of the day, I know you and I have worked on a few clients that we've walked away from, but we know we've given them that peace of mind, be it a life event, it could be an illness or death or a promotion, something positive, or birth of a child. We've been on that journey with our clients, and we give them that peace of mind. The next session that we're going to touch on, I'll touch on that after maybe we address a few questions. I know we're nearly out of time, but there was a question that came up, Adam, in creating a wealth plan, could you just tell us briefly what kind of time commitment do you actually need to put into that?
Yeah, I might quickly just run you through the process. So I guess how it works is we'd like to have a discovery session with any prospective client. So that would usually take on average about an hour and a half as a meeting, because within that session, it's incredibly important to understand, you know, what the real motivating factors are in that person's life and what's important to them. That allows us to complete that goal setting exercise and I guess gather as much information as we possibly can about your financial position. So time commitment wise in that first meeting, it's an hour and a half. And I mean, how we usually do that is that is complimentary as well. It's a real chance for you to figure out whether you want to work with us and if we're the right people for you. From that, I find that we will then go to a strategy meeting. And in that meeting, what we'll do is with our modeling, we'll project out your current situation as if you didn't make any changes. And then we'll provide, you know, some alternative situations or scenarios that would, you know, clearly quantify the value of the advice. So we'd show some different sort of steps you could take to put you in a better financial position. So I think really up front, it's an hour and a half in terms of time, and there is some time to gather any additional information that we would need, but that's very much dependent on, you know, the client's particular circumstances.
Okay, I'll address just one more question before we let everyone go. I know it's just a lunchtime break. What are the outcomes? So if I come into a meeting with you and I sit there and I invest that time, what do you give me to walk away with that will give me that peace of mind?
I think from that first discovery meeting, I think it's really about having an understanding of what your goals are and how realistic they are, which I guess can be a difficult moment for some people where they realise that we might need to realign expectations and things. So the first meeting is very much a relationship thing. As an advisor, we're privy to so much information about people. It's not only the financial position, but it's really a personal and family story that you know, we're exposed to, which is fantastic. But it's a real trust relationship that we need to establish. And as I said, if we're not the right people, then you need to find someone that you're comfortable with. So I guess from the first meeting, it's more about having a trusted person that you can rely upon. I think most of the value financially comes from that strategy meeting. That's where we really project out your current situation. We project out alternate situations and really clearly show you what the benefit of particular strategy recommendations will have for you. So I guess the second one really is where you can quantify the value, whereas the first meeting, it's more of an intangible benefit that you would derive from that first discovery session anyway.
Yeah, that's excellent. Our next session will be in a month's time, and hopefully you can spare the 30 minutes to be with us. Siobhan Sada, one of our principals, will be talking about taking that strategic element that Adam has spoken about and then showing us the tax implications of that and looking at structuring and things like that. So if you can spare the time, please join us, or please just request the video link for afterwards. Again, thank you again for joining us, and we'll see you next month.
Thanks, everyone.
Thanks, Adam.
Bye.
Thank you.